Credit Suisse, one of Europe's largest banks, has announced plans to dramatically reshape its operations. The bank will cut costs and sell several parts of its business to improve its financial health. The Swiss bank will effectively break up its investment bank, splitting its advisory and capital markets unit, and sell the majority of a trading business. And critically, by 2025, it will cut 9,000 jobs, starting with a reduction of 2,700 positions in the fourth quarter. Credit Suisse also plans to raise around $4.1 billion to fund the transformation through a rights issue and by selling shares to investors, including the Saudi National Bank, which is contributing $1.5 billion. The management is trying to calm investor nerves and reclaim credibility. So far this year, the bank's share price has declined over 50% as investors and wealthy clients rushed to the exits following a string of scandals and management changes. A spying scandal led to the exit of Chief Executive Officer Tidjane Thiam in February 2020. A year later, in March, the collapse of Archegos Capital, led by Bill Huang, led to the loss of $5.5 billion for Credit Suisse. In the same month, the bank was hit by the troubles at financial intermediary Greensill Capital, putting $10 billion of financing in peril. Chairman Antonio Horta Osorio resigned in January 2022 after breaking quarantine rules during the pandemic, making way for the current chairman Axel Lehmann. Shortly after, a Guardian article alleged that assets worth $100 billion held by Credit Suisse belonged to people who profited from torture, drug trafficking and money laundering, among other serious crimes. Credit Suisse has seemingly bitten the bullet, and fears of a contagion may have dissipated. But the return to normalcy for the 166-year-old bank will likely be long drawn. In Mumbai for BQ Prime, this is Alex Matthew.